Hello, I'm Sandy Weaver with Weaver Financial. Let's do the numbers. In a nutshell, in the second quarter, bonds again lost money, about what they lost in the first quarter, and stocks headed south into a bear market. Inflation has grabbed the news. COVID remains subdued but ever present. Russia's war on Ukraine and the impacts on us and Europe have become part of our world. That's in energy prices, gas prices, food prices. We should be thankful we're not in Africa, where the food shortage from this war hits harder. The Federal Reserve is stamping down on inflation, increasing short-term interest rates. For the year, U.S. large companies are down 20%. U.S. small company stocks have lost 23%. Overseas stocks are in the red by 18%. Instead of cushioning stock losses, their normal rule, bonds have lost 10%. Corporate earnings on U.S. large companies are expected to increase 5% this quarter year over year, after growing 4% in the first quarter. Overall growth for 2022 is predicted to be 10%. Businesses are doing well. Supply chain issues are ameliorating, inventories are building, labor shortages are still dire but less so. Inflation on both inputs and labor, along with rising interest rates, are the problems. The U.S. economy tanked in the first quarter by negative 1.6%. 2 quarters of negative GDP growth is considered a recession, but the pros are mixed about the second quarter. Some think it expanded, others think it contracted again. Regardless, it's slowing from last year as we expected. The June unemployment rate remains at its 3.6% low. June's average hourly earnings increased 5% again, but that's below June's 9% inflation. The labor market is tight with 2 openings for every person looking for a job. So why are stocks in a bear market? The Federal Reserve raised interest rates 0.25 in March, 0.50% in May, 0.75% in June, and they were pre-releasing they will hike another 0.75% in July, all to combat that 9% inflation, with more to come. You're seeing rates rise. Mortgage rates are jumping, rates on money market funds are higher too, and more. Although we likely haven't felt it yet, the Federal Reserve also began reducing the size of its pandemic-induced balance sheet, halting asset purchases, and slowly removing the liquidity stimulus. So far, inflation remains undeterred, but the Fed intends to do what's needed to kill it. When interest rates rise quickly, businesses, the economy, and stock markets suffer. The bond markets are also taking a hit because interest rates were at historic lows. Prices fall when rates rise. Prices are falling more now than the interest we're getting at these levels, resulting in net losses. Usually bonds buffer the losses in our stocks, but not so far this time. What is happening internationally? Europe is dealing with an energy crunch due to their reliance on Russia and sanctions. Although the U.S. is exporting over record volumes of petroleum products, Europe's diesel prices are close to $10 per gallon. Their electricity prices are 10 times more than ours. Central banks overseas are increasing interest rates too, but they may not hike as much as here in the U.S. Their economies are not as overheated due to the impact of the war there. China and Japan are in their own world, lowering interest rates to stimulate their economies. China's COVID lockdowns have cramped businesses there. Here's an interesting fact from a recent economic seminar I attended. Both China and India continue to buy oil from Russia, but they're buying at $40 per barrel, not the $100 market price. That's an old game for them, apparently. Bottom line, lots of unknowns. If corporate earnings come through, we may have a decent 2022 for stocks if no recession appears imminent in 23 or 24. If interest rates rise further, demand slows and earnings growth slows, Then we may dip down further or slide sideways until that resolves. The stock market usually looks 9 to 12 months out, so corporate guidance during upcoming earnings seasons is key. What do businesses see ahead? Reading the Federal Reserve tea leaves will be key. For bonds, those should stabilize soon. Some pros think the worst of the price losses there are behind us. We should reap better returns from higher interest rates going forward. It's important to know your risk tolerance levels, and we've done that. We diversified our portfolios well over highly rated investment choices. We built reserves some time ago for short-term spending, so we're not forced to sell stocks down here. As long-term investors, we're well situated. Thank you for your interest. Please call or email if you want to dig in further. I'm glad to pass on articles I've read and the other sources I tap.